Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We had some economic data, of course, today. Retail sales came in better than expected. Retail sales, the headline came in at 0.1% positive for the month of August. The expectation was negative 0.2%, so better than expected. The prior period also revised up. So that it's kind of a little bit different than what we hear from some of the retailers who kind of call out the weakness that they are seeing, particularly from the lower end of their consumers. But let's break down some of these numbers. We can do that with Jill Blanchard, President of Enterprise Client Solutions at Advantage Solutions. So, Jill, what did you make of the retail sales data we got this morning?
So, hello, and thanks for having me back. It was a surprise, right? This could be indicative of many things, but the first thing that I'll point to is earlier holiday spending. And so retailers have been pulling holidays forward with good deals, and it's kind of working. 63% of consumers said that they would buy products earlier if on sale. Holiday creep's always been a thing, but it's so exaggerated today that virtually every week of the year, there's some sort of holiday in store. We saw that this summer with Summerween, if you've heard that term before. So the back to school holiday shared shelf space with ghosts and skeletons and a lot of orange and black. TikTokers were making jack-o'-lanterns from watermelons. There were skeletons on pool floats. Starbucks brought the ever so popular pumpkin spice latte out earlier than ever before. And home improvement stores jumped on the bandwagon with halfway to Halloween in April in hopes of addressing their sluggish sales, as well as trying to deplete that inventory so they have less to discount come the first day of November. So that could also be, leaning in towards this increased spending.
Well, Jill, love a pumpkin spice latte. That's a good call out there. I wanted to know, so of course, when we're looking at retail sales earnings and just all the data that's coming in, it can really feel like a slew. We can't really get a read on the consumer here. Has this offered us any more clarity?
Offers more clarity. Probably not. Because again, consumers are really shifting the way that they spend. The predictions for this holiday season are to be softer than last year at 2%. Versus 3%. We do see consumers continuing to buy, but trying to buy lower cost alternatives. We saw that with back to school, where the volume was flat, but the dollars were down, indicating that they're buying, they're just finding cheaper ways to buy things. And I think we're going to see that this holiday season too, especially with things like the deep discount Chinese shopping apps, Temu, Shine, TikTok. 2/3 of consumers have shopped those apps, and that's a number that we'll likely see go up. And I bring those up as the examples to answer your question because it's blurry out there, things happening in both directions.
Jill, for this holiday season here, how promotional do you think retailers are going to have to be to drive their top line?
They're going to have to continue to be very promotional to drive their top line. Historically, pricing and promotions were used to boost year-end sales, but now they're used to boost everyday sales. And it's really driven by how consumers are spending and potentially a permanent shift in how they spend. And so we see a lot of growth from discount retailers, private brand, sales in general, and consumers are definitely leaning in towards those strategies. In some households, are doing even more things, like using alternative pay plans, like a buy now, pay later, getting a second job, sharing groceries, leaning on social media. The hashtag back to school hauls was a huge help to parents during back to school season.
I mean, I think when we're looking at this, and the market has really been on edge with investors really worrying about the consumer and how it may hurt the economy and the labor market. I mean, does this really show that the consumer may be stronger than many people think?
Oh my, I'm so hesitant to lean into that. All predictions for the back half of this year, as well as the holiday season, aren't incredibly positive. Economists think that consumers will rein in their spending in the back, even though we didn't see that with the results this morning, will rein in their spending in the back half of this year due to depleted pandemic savings. Lower income households have record levels of credit card debt. uncertainty. And those low-income households, by the way, are disproportionately affected with inflation. We saw that a few weeks ago when Dollar General said that the weakest 3 weeks of their quarter were the last weeks of each month, indicating that consumers are really struggling to stretch that budget. So for those reasons, I'm super hesitant to lean into overall growth in the back half of this year. We still think it's going to be depressed.
What is skimpflation?
It's a great question. I'd say that this industry is not short of creativity, right? So we all know what shrinkflation is. We talked about upflation, which is that concept of finding a new use for an existing product. Skimpflation is the concept of producing a product or a service with a lesser quality, or not quality, lesser price ingredient. So for a food product or for a piece of clothing, that could be a cheaper ingredient or material. For a service, that could be something like a hotel stay with no cleaning service.
Yeah, I've seen that more and more, but less and less now after the pandemic. Pandemic was really prevalent. Now it's less so.
Definitely. I mean, we can't really look at any one data point, but as we're looking toward the Fed tomorrow, of course, this will not necessarily play into this one, but we're looking toward the next job report. How is this just telling us about the strength of the economy more broadly?
Yeah, so there's a lot of discussion around the rate cuts and what that might ultimately do to spending. Historically, spending goes up about 0.5% in the year following a rate cut, but also goes down 2 to 4% in a recession. Where we are, soft, but not quite a recession. We could see a slight decline in 2025, but overall, it's going to take a while to revitalize the economy via the rate cuts.
Just real quick, Jill, how important is brand loyalty these days?
Oh my gosh. I can't tell you how many times I say this. The new loyalty is disloyalty.
Oh.
Which the new loyalty is disloyalty. We are training consumers to be disloyal. We are training them that there is always a deal to be had out there, whether it's at a different outlet or whether it's waiting. So loyalty's definitely declined, and retailers are trying to get that back. So for example, take retailers' loyalty programs. It's a great way for retailers to pull that consumer into their store for that trip because it's the only place to get that price. But consumers beware. It often does have consumers buying things that they didn't need or more than they need. In fact, we just did a recent survey where 80% of consumers said that they're buying more product than they need because of a good deal.
Yep.
So it's a great strategy for retailers, but consumers beware.
Entry load is what it's called. Jill Blanchard, thanks so much for joining us. Jill Blanchard, she's president of Enterprise Client Solutions. The firm name is Advantage Solutions, joining us via Zoom from California today.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, it is time to get right to it. I'm going right to our guest, Danielle DiMartino Booth, CEO and Chief Strategist, QI Research. You want to talk Fed? This is the go-to source. We're so glad to have her in our studio. She's based down in Dallas. She was a former Fed person down there in the Dallas Fed, so she knows a thing or two about this central bank here. Danielle, what do you think they should do tomorrow?
I think they should have. I mean, since we're doing shoulds, right? And
Yep.
by the way, I do analog, so it's my birthday today. So I'm just
happy birthday.
I'm right there with you with the analog.
Are you legal to drink now?
I
Yes,
may
just barely.
Possibly.
It's also Liz Ann Saunders' birthday.
It is
today.
also Liz Ann Saunders'
Wow.
birthday. We
Birthday
always
twins.
are like the first ones to wish each other happy birthday
very
on
cool. Very
Constitution
fun.
Day. Anyways,
Wow.
I think that they should have, if we're doing shoulda, coulda, lowered in July. And I think that they know that. And I think that had they lowered in July, because they had a quote unquote real conversation about it, according to Jay Powell at the podium, that they would subsequently be lowering again 25 basis points tomorrow, which is why I think 50 kind of makes sense, because the level of interest rates 50 basis points lower than what it is right now is appropriate, given Bloomberg's bankruptcies came in at 8 in the last week, and we've seen another one since then, the second highest this year. I mean, obviously the lag effect is taking effect in the credit markets. It's much more difficult to find funding if you're a bad building or a bad business. So I think, and it's harder to buy a car, and it's harder to refinance your home, and a lot of things say that the level of interest rates is too high, and I think that that's what they should be focused on, the level.
So you said that you think that they should have cut back in July. So what are your expectations for tomorrow? I mean, are you in the more ambitious camp? Are you looking for 50 basis point cut or 25?
I've been around the Fed for a very long time. And to say, and Bloomberg does a great job of tracking the volatility and the uncertainty of the wagers on whether it's going to be 25 or 50. We haven't seen uncertainty this high since 2007.
Wow.
In terms of the WIRP, W-I-R-P, go. So it's so difficult to say. And Bank of America came out and drew the lines hard this morning, and they're like, it should only be 25. And Michael Feroli at JP Morgan Chase is like, it absolutely should be 50. My buddy George Goncalves at MUFG, kudos to him. He's been saying 50 the whole time because he's looking at the level. So I think that they've done enough broadcasting and moved markets to a great enough extent to break the 75% rule if need be. But that's what it would come down to. It would be breaking the 75% probability rule.
So once the Fed does begin tomorrow, what's the cadence after that? Like, when would they like to be done? How does that all work?
So I think from my experience on the inside, you sort of know it's time to ease off on easing.
Yep.
When you start to see the lag effect from tightening dissipate.
Okay.
And those are things that are visible, right? Because BCY go. You can track the level of bankruptcy, you can track the level of distress in the system. When that starts to ebb off, then obviously financing is opening up enough to provide adequate liquidity to the system, adequate liquidity to the credit markets. And so that's kind of when you know.
Yep.
And I think Jay Powell et al., I think it's what's unique right now is we've got a Fed that wants to stop with a 2 or 3% handle. They're like, we can put 3 percentage points of cuts out there and still not have to worry about going back to the zero bound, which they know is a failed experiment and encourages too much speculation.
And going off of that, I mean, markets are pricing north of 100 basis points of cuts through the end of this year. Mm-hmm. If that holds, does that mean that the later meetings would all be 50 basis? How would that work exactly?
Look, Jay Powell is the least political Fed chair since Paul Volcker wandered the buildings and gave the staff and seminars on why the Taylor rule was broken, just for fun, and did not care what Wall Street thought. Jay Powell is very apolitical. So if it needs to be 50, it'll be 50, because when he says I'm data dependent, he's data dependent. If we see that, there's enough gig workers out there that have been absorbed, and ergo they're finally starting to apply for unemployment, because we're seeing a massive runoff from the 1 million full-time jobs we've lost in the last 12 months into the part-time for economic reasons pool. I had an Uber driver yesterday, first drive of his Uber life.
Wow.
But you get that a lot, because people are like, okay, the state's going to get, wherever I live, state X, Y. Heck, if it's Tennessee, 12 whole weeks, that's their max for unemployment benefits. I can maybe get $295 from the state, or I can get at least $1,000, $500, $700 driving Uber, delivering DoorDash, whatever it is. But at some point, you're going to saturate that market in terms of, it's a lot quicker to get an Uber today than it was 9 months ago.
Yep. So just real quick, what's the labor number that gets you spooked, whether it's an unemployment rate or just what's the labor number that gets you spooked? And maybe you might already be there. I don't know.
Well, I'm kind of already spooked. I really am. To see the rise in part-time employment, to see the economic to population ratio already dive down into recessionary territory that's on par with that of the 2007-2009 Great Recession, to see in University of Michigan bad news heard on unemployment go spiking, to see people's expectations for their income go down for 6 months in a row. That's a data series that goes back to 1980. We've never seen 6 months in a row of people saying my income is going to decline in the coming 12 months. Why is that? Because they're going from full-time to part-time. They know that we had 379,000 55-year-old plus rejoin the workforce in August. Hey, I'm going to go back to work to help my kid who doesn't have a full-time job anymore. We've got to put food on the table for the grandkids.
And I just saw that Sam's Club, they're raising the base rate, starting wages in the U.S. from $15 to $16. And I keep an eye on that because my last job will be as a greeter at Walmart. I know that. Danielle DiMartino Booth, CEO, Chief Strategist, QI Research, joining us live here in our Bloomberg Interactive Broker Studio, which is an absolutely perfect guest to have the day before the Fed.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Nora, are you a TikToker?
I am. I'm excited for this segment.
All right, well, good. I mean, I'm not even going to ask John Tucker if he's a TikToker. I know where that's going to go.
Sorry.
Do you know what that is, John?
What's that?
There you go. All right.
Apparently,
yesterday, the hearing went poorly for TikTok in its legal fight against a U.S. law forcing servers and app stores to stop hosting the video sharing app in January. That's not bueno for them. Matt Cheltenham, he follows all of this stuff, media, litigation. He's down in Washington, D.C. for Bloomberg Intelligence. Matt, can you summarize what the case was before the court and what their ruling was? Are we going to be able to still have TikTok come January?
Well, I think if TikTok wasn't concerned about a potential ban before yesterday's hearing, it should be concerned after that hearing yesterday. It did not go well for the company. What's at issue here is in April, Congress passed a law that said unless TikTok is divested to a company that doesn't have its parent in China, that companies in the U.S. can no longer carry the app in app stores. Companies can no longer host it in a way that the app can be distributed, updated, or maintained in the United States, as of January 19th. And TikTok has said, look, we can't do a divestiture. It's certainly not on that timeline. And so TikTok's only chance to survive in the United States after January 19th is to win this legal case. And yesterday's hearing was the big hearing on the case. And the three judges on the case, in my view, were not very sympathetic to the company's First Amendment case.
And so is this isolated to the United States? Are there any other, countries that are also trying to crack down on TikTok and its influence?
I think different countries are taking different approaches. The EU has taken a harder approach to tech regulation generally, and likely would apply that to TikTok without a specific ban in the same way, according to our analyst Tamlin Basin there. So this law is U.S. specific. It was passed by Congress specifically to target the company. And so it's a different remedy here in the U.S. But there's a tendency, I think, to think, nothing's going to happen in Congress. Nothing ever gets done there. Just a lot of talk. Well, here, Congress did it. It's done. It's law. And TikTok's only chance to overcome it is to win this legal case.
So the parent company for TikTok is ByteDance, a Chinese-controlled company. If I misstated that, let me know. What has ByteDance said about their options, what they plan to do, scenarios?
Yeah, so that's right. That ByteDance is the parent company of TikTok. Now, TikTok is a U.S. subsidiary. It's a U.S. company. TikTok is a privately owned company, but it happens to have its headquarters in China, and that's the concern. And TikTok and ByteDance in this legal case have basically said, look, a divestiture is just not technically or legally feasible. And so there's really no indication that they're pursuing a divestiture at this point. And at least that's their indication to the court. In fact, the law allows a 90-day extension if the president sees they're making progress on a sale. But the companies, they've made no indication they're pursuing that route. They say this is a blatant violation of the Constitution, and so they think they can win in court. But I'm not so sure after yesterday's hearing.
I mean, so what do analysts think are would be the broader readout for the corporate side of things? I mean, of course, we know so many companies actually promote their products and their companies on TikTok. I mean, when I'm scrolling through, I'm always seeing a new pitch. So what does that look like in terms of advertisement and the ripple effects there?
Yeah, that's right. And part of the litigation yesterday was brought by users of TikTok that say, look, there isn't a good substitute. Yeah, there are other social media companies, but we've built our businesses here. We are expressing ourselves as a First Amendment matter on TikTok, and the government can't take that away. And there's also a big business impact in terms of TikTok's competitors. TikTok is one of the leading social media apps in the country. So if it goes away, it's a great opportunity for the competitors, for Google, for Meta. And so there are serious business implications by forcing a divestiture that isn't going to happen and effectively forcing a ban.
Is this something that could get to the Supreme Court?
Yes. So if TikTok loses in the D.C. Circuit, I expect we'll see a decision by early December from the D.C. Circuit. As I said, the key deadline is January 19th here. So there's not a lot of time. If we see a decision in December from the D.C. Circuit, TikTok's realistic only chance at that point is going to be a last-ditch plea to the Supreme Court to hit pause on this, to say, look, nothing should move this fast when you have such a major restriction under the First Amendment. The Supreme Court should issue a stay and take up this case. That's going to be TikTok's last chance to dodge a ban by January 19th if this ruling goes against it. And I'm not sure the Supreme Court will necessarily take it. Yes, it's a major question that they might be interested in. But if TikTok gets a major loss at the D.C. Circuit, the Supreme Court could say, look, they got it right. We don't need to step in here. So it's not even a sure thing that the Supreme Court will take it. We'll have to watch that in after the D.C. Circuit rules.
All right, Matt, thanks so much for joining us. Expert analysis there. I tell you, folks, it's hard to find that kind of analysis anywhere else but Bloomberg Intelligence. Matt Schettenhelm, media litigation analyst from Bloomberg Intelligence down in Washington, D.C. It's a huge case. I mean, you think about not just all the people that are on TikTok, but all the businesses that have been built upon TikTok.
And what happens to the dances? Are we not going to dance anymore?
Exactly.
So you get like 15-second videos of some guy chopping wood
Where's
or
the fun?
somebody dancing?
I don't know. But
And we're afraid that we're going to lose that?
It's going to be big. We'll stay on top of it. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It's not just us here at Bloomberg that are fixating on what the Fed's going to do tomorrow. Real people, smart people in Cleveland, Ohio, they also are going to focus on that. Anna Rothman joins us here. She's a Chief Investment Officer, lyrical soprano, CBiz Investment Advisory Services. They're based in Cleveland, but she joins us here in our Bloomberg Interactive Broker studio. So, Anna, when you take a look at your portfolio, kind of the advice you're giving your clients, what have you been telling them about the Fed and what the Fed's doing and why it matters, or does it matter? Those types of discussions.
Oh, it matters.
Okay.
It has plateaued for over a year now, and they're tomorrow, 25 or 50. In some ways, it doesn't matter because it's just the first step that they're taking in what we believe is a cycle of cuts. It's still going to be restrictive after 25 basis points or 50. We do think that there are other considerations they need to think about, which is if you go back to the March projections and then look at the June projections, there was a huge revision, right? They got more hawkish. Now it looks like the March revisions, maybe it would have been better if they had stayed put. So if we look at that, we have 3 cuts coming up, 25 basis points each. September, tomorrow, 25 basis points, that's what we're expecting. And then maybe November and another one in December. So that's what we've been sort of relaying to our clients and certainly preparing our portfolios.
And this has definitely been such an interesting cycle, unprecedented. But I mean, when you're looking at those projections for cuts throughout the end of the year, is that based on historical patterns, or are you all, what's the thought process behind that moving forward?
I don't think history helps us here.
Right, not at all.
Yeah, no, it's, this was a pandemic-driven inflation, and the Fed had to do something pretty dramatic. Coming down, I mean, it was sort of obvious they had to raise rates, right? Maybe it wasn't at the time, but in hindsight it was. Going down, I don't think is going to be as easy. And the data dependency, I think, comes from the fact that we can't rely on history, but at the same time, data dependency is making things very volatile, especially on market expectations. So we're literally we're taking it 3 cuts in 2024, but also one meeting at a time.
How about if you have put cash to work here? I don't know. It's kind of tough one. I think John Tucker was going to put some cash to work in some money market at 6% or something?
Well, no, the Goldman Sachs Marcus.
Marcus.
But it's just like, my question is, are stocks going to see competition from the higher or from bonds at some point, fixed income?
Well, cash has been near 5 and there was no competition, right? So I'm not sure if bonds are going to be necessarily any different. Now the price it's been favorable for bonds, right? But that also means the income's going down. So lock them in.
We've heard of some people maybe repositioning the portfolio to maybe take some of the gains from the stocks that have really run, whether it's the big tech and putting. Is that something you guys do too in repositioning your portfolio? And how often do you do that?
Yeah, so we have institutional portfolios, so it's pretty much fully invested, and there's an IPS that we have to stick to. So what we do is oftentimes, and we have seen this in the last not just 2 years, but going back to pre-pandemic, a huge discrepancy between growth stocks and value stocks. So we do separate them, and when growth stocks run as they have, we take the gains and reinvest it into the cheaper stocks. So that's kind of how we deal with some of the irrationalities of the market.
So I'm always looking at interest rate sensitive sectors, as I'm sure everyone is. I look at real estate stocks, I cover them. Are there any sectors in particular that you're really eyeing as we head through this, rate cut cycle? Are there any sectors that you think could really outperform from this?
So small caps, certainly. And we have seen that actually starting in July. Also starting in July, what you saw were some REITs, public REITs that were recovering. Just to give a sense, I think office REITs since the end of 2021, when Fed really started to raise rates, it was down like 40% or so. But you really saw that recover since July. So a lot of the interest rate sensitive areas, not every area was, Mag 7 definitely wasn't. I think those areas are poised to outperform.
And again, they're outperforming today. The S&P 500 is up 0.4%, but the Russell 2000 is up 1.7%.
There you go.
So we're starting to see that already. Anna, thank you so much for joining us. Anna Rathbun, Chief Investment Officer. Lyrical soprano. I am Googling for some of her performances as we speak. That's what I was doing earlier.
Oh, no.
So I'll be checking it out on the commute home here. CBiz Investment Advisory Services. That's the day job, but a lyrical soprano.
I want to learn to hit those notes.
Oh, please. My sister's a great singer, so she's the only one that got talent.
I think I'm like an alto too. Whatever's probably maybe right before tenor.
Okay.
We can do a duet.
I can't get up there.
Do a duet. Thank you so much, Anna.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We love talking to Kate Richards. She's the CEO and co-CIO at Warwick Investment Group. We love talking to Kate just to get a sense of what's happening in the world of, global energy, natural gas, crude oil. Kate, thanks so much for joining us here in our studio. Let's talk about just WTI crude oil. We're at $71 a barrel here. We did fall below 70 here. Give us the state of just global crude oil. Is it a supply issue that's been pulling oil down, or is it demand, or a little bit of both?
I would say it's probably sentiment more than anything else. There's nothing that could explain a $20 to $25 barrel drop in prices for oil fundamentally. But it's very important to remember that oil is often not a fundamentally driven commodity in terms of pricing. The financial demand for oil and petroleum products is actually 30 times the size of the physical market. So if you look at all of the contracts that are trading for oil and oil products such as gasoline, jet fuel, et cetera, that market is 30 times the size of the actual physical market for oil. And so what that means is that the financial sentiment around oil can actually have an enormous impact on prices that isn't actually reflected in fundamentals. And I'll talk about fundamentals in a second. If you go back to 2015 to kind of illustrate the point that I just made, in 2015, we had a 2% oversupply, so not horribly oversupplied market, that triggered a 60% price decline. Wow. That doesn't happen in a normal market. You don't have like a 2% oversupply in multifamily and a 60% decline in rents. So that's fundamentally what we're dealing with in terms of sort of the sentiment around oil, and that kind of goes to the hedge fund point we were talking about earlier. I will say that the sentiment around oil is a little bit driven by Chinese demand. So Chinese demand numbers are not great. They actually contracted in Q2 on a year-over-year basis. However, 2023 was exceptionally strong. And China's about 17% of the market. When we look at, the idea that you could extrapolate Chinese demand to what's actually going to happen in oil prices, I would say two things. Number one, the correlation of Chinese demand to global demand, so 17 million barrels a day of demand to what happens with the other 83 million barrels a day of demand, is like 6.8%. So on an R-squared basis, that's meaningless. Okay. And if you look at Chinese demand, when you look at Chinese demand to non-OECD demand, which has been a driver of oil growth, and so that's important, it's like 0.1%. So obviously meaningless as well. So China's weighing on sentiment, but we need to think about what that actually means in terms of global demand growth. And the last thing I would say is that oil and gasoline demand were at all-time highs last year, and they are also at all-time highs this year. So really nothing to
below
explain.
$3 a gallon coming in.
He's our gasoline correspondent.
This is our guy.
Because he drives 500 hours a day.
Well, I mean, the Fed can thank oil prices for being able to, even entertain a cut. If you had $90 to $100 oil prices right now, it would be.
What
very
is that
difficult
on an
to cut.
inflation-adjusted basis?
Good
That's
question.
deflation.
Good question. Oil is at 2004 levels.
Wow.
Which is incredible for the most probably valuable commodity in the world.
So, I mean, of course, we're sitting here in a very special week. We've got the Fed tomorrow. How does this all play into that? Expand a bit more on that.
Well, obviously, I think when you look at the impact to consumers, we also are thinking about it being an election year. And I would not say that the correlation is, it's a spurious in terms of correlation and may not be causal. But normally we have weak oil prices in an election year. That's number one. Number two, it's refinery turnaround season after peak driving season. And so you are going to have, refineries undergoing maintenance, so they will be consuming less oil. That will make demand look a little bit worse. And so we're seeing a little bit of an impact from that. But, when you look at like overall inflation levels, inflation has cooled over the past year, but we're not back to 2019 levels. We're still, if you look at the price of bread to gasoline, you're still much higher than 2019 levels. And oil just has helped a little bit because it probably really is undervalued, especially relative to the cost of supply.
Alix has been, I think, on the forefront, at least from my perspective, in reporting on this whole AI play for global energy. And it comes down to simply, you're going to build all these computer farms and things and all that kind of stuff. Somebody's got to fuel it. And the question, is it coal? Is it gas? Is it oil? Is it nuclear? Mm-hmm. How do you guys think about that whole thing? Because people are trying to say there's an energy play here to AI.
Yeah, I mean, the future of AI is going to be who controls the energy infrastructure related to it, clearly. And so then the question becomes, is it natural gas? Is it nuclear? Is it renewables? Is it coal? I think that, what we see as big tech is certainly hanging hopes on the AI revolution and the growth in data centers that will be needed on a nuclear renaissance. And there's some interesting things to say with respect to that. So number one, uranium prices are down 20%. And that's partly because Kazakhstan announced that it's increasing production a bit. Secondly, the House and Senate just passed a ban on Russian imports of uranium, which is about 20% of the U.S. market. U.S. is the largest consumer of uranium in the world. And that kicks in 2028. So the U.S. consumers will be needing to look for alternative sources of supply for about 20% of their supply. And lastly, we are starting to see groups like Amazon go and buy nuclear power plants to see if they can power some of data centers with uranium-powered nuclear. Nuclear is clearly carbon neutral, and it also has the most uptime of any power producing asset in the world. It's like over 90% uptime. So uranium is very interesting, especially given the sell-off. The other question is how much of this is powered by natural gas? And that is a very interesting strategic question for the U.S. because the U.S. North America is a natural gas province, and we are the Saudi Arabia of natural gas. and we have cheap domestic sources, especially with gas at $2.40. However, gas is in pretty steep contango. So December 2024 prices are at $3 an M versus $2.40 spot prices, and next year it's at $3.80 an M. So that it shows that we're in pretty steep contango. The market's expecting future higher prices, but remember, gas is fundamentally driven by weather. And if winter doesn't show up this year, as it has not for the past 3 winters, you could see lower prices.
Although I have to admit, I just got a tweet from one of my favorite ski resorts out west. It snowed last night. It's coming, baby.
That's good news.
It's coming, baby.
It's almost time.
So nat gas. Now I just looked at my little Bloomberg charts. Down like 30% from recent highs over the last year. So, is that a supply issue?
Yeah, you've had a fair amount of new supply come online in the U.S. because of drilled and completed wells. And you also have to remember that most oil wells in the U.S. produce natural gas as well. Like 30% of Permian production right now is natural gas. And as those wells get older, they become gassier over time. So this is one of the reasons that people have confidence in building petrochemical and LNG export facilities in the U.S. because we have such robust supply, and we're even getting it basically as a free byproduct from our oil wells.
And I know, as we were talking about earlier, hedge funds are net short oil for the first time since the data started being collected in 2011. I mean, when we think about smart money making this decision, do you think that that permeates into the rest of the market when we're looking at investors more broadly?
I think tactically, number one, it's refinery season. It's refinery maintenance season. So your bid for oil is less. That's number one. Number two, it's an election season. And usually prices go down into an election. I mean, you could say an incumbent, that's in the interest of an incumbent. And then lastly, you have a weak Chinese number, and that is going to spook the market, although we do not think weak Chinese demand can be extrapolated to global demand today. So if I were tactically positioning, I would say I'd be pretty net short too. However, but I would probably close that trade out pretty quickly because we have probably the most disciplined OPEC we've ever had. And OPEC, under the current Saudi leadership, is very focused on price stability. They do not want $30. They do not want $120 oil. They really want it to stay in a tight band because they view that as best for their customers, and they've done a very good job governing the market. So, just an example of that is 2 weeks ago, OPEC came out and said we were supposed to increase production 180,000 barrels a day, and we won't. And that's how they're governing the market. So I think you can make these tactical trades, but you're probably trading in a tighter band. Now, it doesn't mean that you couldn't have a temporary real trade-off or trade-up, but I think you have a market that's being governed in bands the way that it wasn't in 2008, for example.
Is the fact that the U.S. is now a net exporter for the first time, like in ever, how does that undercut OPEC's ability to really be that driver of price?
OPEC has teamed up with Russia, and they are definitely the largest producer in the world. U.S. is like 13% of supply.
That's still a lot, though, isn't it? On the margin, does that not impact it? Because if I got some knucklehead in Texas or Louisiana pumping oil because he or she can, and their cost is $40 or $50 a barrel, does that not impact the world markets?
It does. It absolutely does. The point I'm really making is that OPEC has a cartel with Russia, controls over a third of global production, and they have been committed to price stability. But yes, 95% of global production growth over the past 10 years has come from the United States.
Is that right?
Wow. The United States is really the only jurisdiction that's been able to grow.
Here's the final question. Can you answer this one? Because nobody else can. And I can't, and you can't. Why can't we pump gas in New Jersey? Do you have any idea?
It's the question of the day.
I think there are only 2 states. It's New Jersey. I don't have a problem
You mean
with
where they pump it for you?
New Jersey.
Yeah, right.
And
they have to pump it for you.
It was New Jersey and Oregon. I think Oregon just went to I don't know.
It's a good question.
I think it's a luxury.
Okay,
I agree. It's a luxury.
It's your homework.
Are we complaining?
It's your homework. All right, that's how we roll, Kate. We see when Alix is not here, we go off the rails, but we appreciate it. Kate, thank you so much for joining us. Some of the smartest talk discussion that we have on global energy, thanks to Kate Richards, as CEO and co-CIO of Warwick Investment Group, joining us live here in our Bloomberg Interactive Broker Studio.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.